$1 trillion. That's the amount that's currently being passed around between three of the biggest companies, without even a single real new dollar entering the system. Today, I want to break something down for you. And if you like this video and subscribe to the channel, by the end of the video, you'll say, yeah, that was the best thing I could have done. And you'll never look at stock market or AI news the same way again. There's a financial game happening right in front of everyone's eyes, and they've called it growth. But when you peel back the layers, you see something else. By the end of this video, I'll tell you exactly which parts of this story are real and which parts are just an illusion. And I'll give you a number that will shock you when you hear it. So stick around until the end, because you'll get the answer to the question everyone keeps asking right here. Is now the time to be scared or not? Let's start with a simple question. How is it possible for a company to take hundreds of years to actually deliver the profits it promised its shareholders, yet people are still lining up to buy its stock? This is exactly the situation with many of the world's biggest companies today, and the justification for it's pretty strange. It's like everyone has accepted that the future is going to be a paradise where artificial intelligence solves everything, brings costs down to zero, and creates infinite growth. The problem is, at the same time, we're facing an energy war, resurgent inflation, massive debts, and trade tensions. In other words, it's exactly the opposite of the paradise that stock prices are predicting. Now, there's something I want to tell you, but I'm going to save the answer for a little later. There's a number that Warren Buffett, the most famous investor in history, has called the best tool for measuring bubbles. Right now, this number has reached a record that's even higher than the peak of the dot-com bubble in 1999, and I'll tell you what percentage it is in a bit. But before that, let me give you a historical comparison that you've probably never heard anywhere else. Come with me to 19th century England. In the 1840s, something called the railway mania happened. Back then, railways were like what artificial intelligence is to us now. It was a revolutionary technology that was supposed to change everything, and it really did. But the problem was that hundreds of railway companies were all established at the same time. All of them promised billions, even though the entire British economy back then simply didn't have the capacity to build that many rail lines. Ordinary people, workers, even church clergy, all of them poured their savings into railway company stocks. At the peak of all this, about 1/3 of all the circulating capital in Britain was locked up in just this one industry. Then the market crashed. Hundreds of companies went bankrupt. But here's the interesting part. The railways themselves didn't disappear. The infrastructure that was built became the very foundation that turned Britain into the industrial powerhouse of the world for the next 100 years. In other words, the technology was real, it's just that the money invested in it was foolish and excessive. Remember this pattern, because we're going to come back to it. Now, let's get to what I think is the most important part of this video, and something that most people talking about the AI bubble don't even mention. There's a mechanism called circular financing. Let me break it down for you in simple terms so you can see how it works. Because once you understand it, you won't be able to trust the growth statistics of this industry anymore. Imagine you have three players. The first company makes chips, the second company runs AI models, and the third company sells cloud space and servers. Now, the first company invests billions of dollars in the second company. The second company takes that same money and signs billion-dollar contracts with the third company to rent servers. And then the third company takes that same money and goes to buy chips from the first company. Now pay attention. Those same dollars have made a full circle and ended up right back where they started. But every time the money passes through a company, it gets recorded in that company's financial report as new revenue and growth. So on paper, you see three big growths, while in reality, it's just one pile of money going around in a circle 3 times. It's estimated that about $1 trillion of current AI contracts work exactly like this. This is exactly what happened in 1999 with a telecom company called Lucent. Lucent would lend money to its customers who didn't have cash so they could buy its equipment. Then it would record those sales as real revenue. For 2 years, everyone thought this company was exploding with growth. Then the customers couldn't make their payments, and Lucent's stock dropped by 99%. Alright, now let me tell you the number I promised you. That index Buffett called the best tool for measuring bubbles has now reached over 230%. That means the total value of U.S. stocks is now 2.5 times the country's gross domestic product. Buffett himself said that when this number gets close to 200%, it means you're playing with fire. Right now, it's higher than any point in recorded history, even higher than the peak of the dot-com bubble. But there's a big difference between today and previous crises. Wealth concentration. Today, the wealthiest 10% of American households own about 87% of all the stocks and investment funds in the country. When these people need cash, they don't sell their stocks, they borrow against them instead. Right now, the amount of margin loans, that is, loans taken out using stocks as collateral, has reached over $1,400,000,000,000. So this small group is borrowing against their assets instead of selling them, and they're holding on to them. This means that, at least for now, the selling pressure is much less than you might think. But this is where we get to a bigger hidden risk, a risk that I think a lot of analysts overlook and just pass by. That debt I mentioned that companies are using, a big part of it no longer comes from regular banks. It's coming from a shadow market called private credit, funds that lend directly to companies outside the view of financial regulators. Last year, almost a third of all these loans went directly into AI projects, while 5 years ago, that number was only 17%. So now, a completely non-transparent part of the financial system is filled with AI risk. And what's even scarier is that some of this money has been loaned directly to the very software companies that AI is supposed to replace. Unfortunately, this is a lose-lose game. That means if AI succeeds, these companies will go under and the loans will default. And if AI fails, the investment in it will be wasted and, again, the loans will default. So what's the takeaway? I think if we go back to that story about the British Railway I mentioned at the beginning of the video, we'll find the answer. The railway technology wasn't a lie. It was just that the money poured into it was foolish. I think the exact same fate awaits artificial intelligence. The infrastructure that's being built now will most likely still be in use 30 or 40 years from now. But the companies that have only survived through circular financing and hidden debts will probably disappear. When that happens, not just the investors, but thousands of employees who thought they were riding the wave of the future will be shocked. So the real question isn't whether this is a bubble or not. It definitely is a bubble. The question is, which part of this story is real infrastructure that's here to stay, and which part is just money spinning around in a circle, waiting for the day it all comes to a stop? The market knows this risk exists right now. It's just decided not to think about it for the time being. But from today on, you know exactly where to look. If this video helped you understand this complicated issue in a simple way, let us know with a like, definitely write your thoughts for me, and subscribe to this channel so you don't miss the next videos.